Good afternoon, everyone. It's Pablo.zuanic, Cannabis Analyst at Zuanic Associates. Thank you for joining us today. We have three CFOs of multi-state operators joining us today. Mario Pinho, CFO at MariMed, Dennis Logan, CFO at Planet 13, and Roman Nemchenko, CFO at Ascend Wellness. Welcome to all of you.
Thank you.
And for
Thank
the
you.
audience,
Thank you for having me.
For the audience out there, as you know, we broadcast this via Zoom. People can ask questions via the chat room in Zoom or email them to me. For those of you listening in Spaces, you can also put your questions in Spaces, and we will review them there. I do filter the questions, but I try to bring on most of the questions that people have out there. We have a lot to cover. Just a bit of a disclosure here for the audience. The purpose of this call is really to talk about fundamentals, talk about the industry, right? There's a lot of the whole reform process gets a lot of attention at the federal level, and unfortunately is the main driver of stock performance. But this is a real industry, right? 500,000 jobs, and a lot is happening, and the industry continues to grow. So the purpose of this call is really to look at the fundamentals and understand how companies are operating and performing. So Dennis, I'll start with you. Please introduce your company, remind us of your current footprint, and in big picture terms, just describe the business strategy and how you can be different from other MSOs. Thank you.
Sure. Guys, Dennis Logan, CFO Planet 13. Pablo, thanks for having us on the call. So Planet 13 operates in 4 states. We have 33 stores, including our flagship store in Nevada. We're vertically integrated in Nevada and California, fully integrated vertically in Florida, and we have a retail operation in Illinois, along with third-party white label wholesale that we've launched recently in Illinois. And then big picture terms, we're an experienced, focused retail brand-forward operator. We're known nationwide really for the Planet 13 Superstore in Las Vegas. We have over 1 million people a year through that front door. And we try to leverage that and the halo effect from that in brand optimization, brand recognition, and try and transfer that to our neighborhood stores in the other markets that we operate in. And we're also using that retail operation in Nevada to launch branded partnerships. As examples, we've got a branding partnership with Wiz Khalifa and another one with Tyson. We do various branding initiatives that we launch out of that store and then try and carry those things nationally as we can. So that's our focus. Big picture.
Mario, go ahead.
Yeah, my name is Mario Pinho. Thanks, Pablo, for organizing this call, and nice to meet you, Dennis and Roman. We're vertically integrated MSO as well. We have dispensaries, cultivation, and manufacturing in Massachusetts, Illinois, Maryland, Missouri, and Ohio. We do have a presence in Delaware, Maine, and Rhode Island, either through an MSA or through partners. First and foremost, I believe, and we believe we're a brand company. We believe if we focus on our brands and our customers, providing the best level of service and education, profits will follow. We're known for our award-winning brands and high-quality products. They include Betty's Eddies, Bubby's Baked, Nature's Heritage from a flower perspective in-house, and Vibations are offered in various states.
Thank you. Roman, go ahead.
Yes, and thanks for having me. So, Roman Nemchenko, I'm the CFO of Ascend Wellness Holdings. I've been with the company for almost 5 years now. We're a multi-state operator, across 7 states, with Jersey and Illinois being our kind of primary core markets from a revenue and EBITDA contribution perspective. Growing the business from 12 million in revenue in 2019 to over 550 as of the most recent quarter. 39 stores across these 7 markets, with 2/3 of revenue coming from our retail footprint and the rest coming from a wholesale business, mainly in Illinois, Jersey, and Massachusetts. We have a decent scale. We have over 250,000 square feet of cultivation, making over 165,000 pounds of flower a year. We have some of the best brands in our core markets in Ozone and Simply Herb. I think we're also known for having some of the best retail on a revenue per store basis, I think amongst our peers. So that's something we, continue to benefit from.
That's good. Thank you. Roman, I'll stay with you. So let's discuss now, the core states in your footprint, maybe, two or three. Just in general terms, discuss the macro landscape in those states, especially maybe New Jersey, Illinois. And also, as you discuss the state of those markets, how do you believe your performance stacks up versus peers in those core states? Thank you. And correct me if
Yeah,
I'm
of course.
New Jersey and Illinois are not the two core. Thanks. Yeah.
Of course. Yeah. And look, we obviously haven't reported our Q4 results yet, so I can't comment on any kind of recent developments, activity. But, looking at 24, over the course of 2024, right, it's no surprise to anybody, Illinois and New Jersey have seen, new store openings. And, I think across the board, right, our peers have similarly reported, declines in transactions, right? With that said, none of that's been surprising, right? The good thing in the kind of how we're set up is to, our wholesale business has been a successful hedge in those core markets, right? In Illinois, we have a pretty substantial capacity. So as new stores come in and maybe you lose some of the customer base because there's more options with shorter distance, driving distance, we also are able to pick up those accounts. I think our penetration in a wholesale business for those just two states varies from 95 to 97% of doors. So from that perspective, I think that strategy has worked well. On a kind of a state level, right? From my perspective, right? Every state's kind of unique, but they all follow similar trends, right? People expect good choices. They expect value, right? They expect you to give them the right offering at the right price, and these are elements that we just kind of have to embrace and do better. But relative to the peers, like I think from what I can tell, we're very much kind of in line as far as what everyone else has seen.
Okay. And just to stay with you on one point. So yes, we've written about this revenue dilution in states like New Jersey and Illinois because of all the new stores that are opening. But the truth is that a lot of these small stores, they may struggle also. And the bigger stores, the established incumbents, tend to have stores that are 2 or 3 times the level of the new players. I mean, is that true or not? Because to some extent, you would think that would deter some of these newcomers. But any quick thoughts on that, Roman?
Yeah, look, there's kind of a short-term and long-term view, right? In the short term, you have independent store operators coming in. Now, mind you, a lot of them began this process many, many months ago, right? It takes well over a year from the time you get a license to the time you open the store and ramp. So, some of these operators, they're coming in and they are competing, but they're competing without access to cultivation verticality, right? And the margins and the cost profile, right? So it's tough. As a retailer, as a new retailer and a small footprint retailer, it's really tough to compete. So, do you see them, does that store count impact in the short term, maybe some transaction volume and price compression, maybe? In the long term, we'll see, right? Because again, it's a tough industry, and with 280E overhang and very high cost of capital, if you're a retail operator earning low 20% EBITDA, it's tough to make money. It's tough to stay open and really compete at those levels.
So thank you. Mario, same question for you. Just describe the state of the markets in your core, the core markets in your footprint. What's going on there?
Yeah, we're obviously in Q4, so I can't really talk specifics and recent performance, but we consider Massachusetts, Maryland, and Illinois our core markets. Obviously, we face the same challenge that Roman just went through. In Illinois, we've from a brand perspective, we've seen one of our SKUs on the Betty's Eddy side jump to number 7 in the market, and that's just having processing. We have just opened up a cultivation and had our first harvest, so we definitely see significant growth there in terms of as we leverage that investment. Maryland has also been good to us since there's less players there and less competition. We're just focusing on brand distribution and getting into more doors. There's still opportunity even in Massachusetts as well, but we see the biggest growth coming in Illinois and Maryland as we kind of expand production there. From a retail perspective, obviously, we're not immune to what's happening from an economic perspective. Consumers are a lot more price conscious and just have less to spend when it comes to share of wallet. We are seeing AOV go down across our markets and transactions as well. But we're continuing to focus on customer service and just being a little bit more creative when it comes to marketing strategies to continue to drive retail revenues. But we expect wholesale to really make up for that. Historically, we see a 30% CAGR on the wholesale revenue side. And the big issue will be just margin compressions from a retail perspective.
Got it. Thank you. Dennis, same question, I guess, particularly if you can focus on Florida, Nevada as your core markets.
Yeah, no, for sure. And those are the core markets, Pablo. We are seeing the same, kind of macro headwinds, consumer running out of discretionary cash to spend on cannabis products, increased competition, price compression in each of the markets, oversupply, especially in Florida with the lead up to the November election. A lot of operators opened a bunch of stores in anticipation of adult use passing, and started producing an excessive amount of inventory there that now working through. So we're definitely seeing price compression in that market. Nevada as well. We're finding we're vertically integrated, but I'd say 65-70% of our product is our own in that superstore, and the balance is third party. There is a lot of price compression in that wholesale market in Nevada, excess supply. So we're able to pick up, product with decent margin, almost to the same level of margin we're able to get on our own vertical product. That's how tough that market is. But the bigger picture for us across Nevada and Florida in particular is the proliferation of Delta 8. It's having a massive impact on the consumer's willingness to part with their dollars when they can pick up a pack of pre-rolls at the gas station. I mean, or they can order it online. I mean, it is having a significant impact on price compression in Florida and Nevada in particular. A couple of the states are looking at trying to bring the Delta 8 inside of the cannabis framework, I'd say, but we'll wait and see if that actually does happen. Because they are missing out on a bunch of tax revenue, and I think that's what really drives a lot of the decision making at the state level. But that is where we see one of the big things we need to work on collectively as an industry at the state level, individual state levels for sure. Florida and Nevada in particular, and so where we stack up, in our core markets versus our peer group, Nevada, we always try to trend between 8 to 10% of the total state's revenue. The state overall has seen that revenue decline, again, largely on the back of that Delta 8 and some of the illegal market. And then Florida, where we recently entered, our market share in Florida has a lot of room on the upside. And I think if we can focus on, improving our product quality and expanding our product offering, we should be able to, increase our penetration in that market. So.
Look, and given that you brought it up, Dennis, I'm going to explore the Delta 8 comment there. And, but we won't make this call just about Delta 8, of course. But at macro level, what we see in various states that the legislature or the governor try to impose bans or temporary bans, then the judicial branch or the lawsuits delay the enforcement of those bans. I mean, so we try to keep track of every state, what's happening, but maybe I'll ask the three of you, but in terms of your core markets, are you getting any relief at all in terms of from the regulators in terms of Delta 8? In your case, Dennis, in Florida or Nevada, or nothing really?
Well, I mean, I don't want to kind of jinx it, but it's we are working with industry groups in both of those states trying to influence the legislators to act, but we'll have to wait and see. I mean, both Florida and Nevada have short legislative sessions this year, and we're working aggressively in both to try and get some forward movement, but nothing to discuss in detail right now, Pablo, in terms of that.
No, thank you. Roman, do you want to add anything on Illinois or New Jersey regarding Delta 8 in terms of the regulatory developments and changes?
Yeah, I haven't heard that much in Jersey and Illinois. I know it's a state-specific issue, right? States like Florida, right? I think sounds like have a higher exposure to maybe hemp, and or maybe there's just more conversations in those markets. It's not something I've heard in Illinois, New Jersey, but it's a topic that we're obviously monitoring closely. And try to understand where the wind is blowing, right? Where there's moats, right? There's talks of, from what I understand, on the beverage side of things, like low THC, are those going to be the customers that are drawn away from our business or not? That's also a question, right? How much of that is going to compete with THC product that we sell? But yeah, our core markets, it's not something that we've witnessed yet, but we're certainly on the lookout.
Mario, any quick thoughts in terms of the impact of Delta 8? I don't know, Illinois, Massachusetts, Maryland, or is not as bad for you?
Not, we're currently monitoring and we're kind of assessing what the impact are in those markets. We haven't identified anything yet. I think I agree with the rest of the panel. It definitely is an existential threat. When I think about the customer, just the level of confusion, just anecdotally, I'm hearing that people are buying hemp-aid type products and actually don't even know that that's different from cannabis products. So we have no plans in that area right now, but definitely something we're monitoring and continuing to review.
Understood. Dennis, moving on here to expansion plans, maybe remind us where you added capacity and stores in 2024, and if you can share anything in terms of plans for 2025. Thank you.
Yeah, so like 2024, we added Florida, obviously through the acquisition of VitaCann, 26-store network with big cultivation. We've built out an additional 5 stores in that market in the end of 24, beginning of 25. We think Florida obviously is the biggest target for us in terms of growth. The failure of adult use was disappointing. I think it comes back on ballot in 26. So give us 2 years to get ready for it. There will be an additional set of licenses issued there, so we'll increase the competition, but I just don't know when they'll come onto the market. I think we do have an opportunity there. We don't have a full product suite in Florida, so we're a little bit operating with our hands tied behind our back a bit, that we're trying to rectify premium indoor and some other concentrate products that we don't have. And I think if we can get those into that network, then it'll expand our average revenue per store in that Florida market, get us back up to a kind of a more normalized level. So that's really our focus is Florida.
I don't know if you can talk about this, but in the case of VitaCann stores, I think you're about 30 stores now. They've been rebranded 13. How many do you expect to have by end of 25? Only if you can disclose that. Yeah.
Yeah, I mean, we've talked about adding another 10 in total, so like kind of get a 40 to 45 store network. We probably slowed down the pace of those in 25, given the lack of passage of adult use, and a little bit more strategic on where they are. Potentially smaller footprint stores than we had maybe originally planned, given that lack of adult use, and just kind of more convenient for the customer. So it's a mixed bag, Pablo, in terms of what we're trying to do in Florida, but that's sort of the target.
And I know you have the one store in Illinois and one in California. No plans to add retail there, right? For the time being?
Yeah, no, for the time being, California is tough, right? Like it's a tough market across the board. If you have great brands, you can survive. Retail is difficult. Santa Ana was one of the only cities in Orange County that was legal, and now we see proliferation of stores all around us in various cities that have come on, as well as in Santa Ana. So it's been a tough, challenging market. Our cultivation in California, we sell everything we grow. We make money at the cultivation, not as much as we were 3 years ago, but it's we do sell everything, premium flower, trying to get our own brands launched in California. It's been a bit of a challenge, so it's a difficult market. I don't think we would open another retail store in California at this point.
Got it. Thank you. Mario, same question for you. If you can remind the audience, I believe that you doubled capacity in Maryland, started operations in Illinois on the production side. Just a reminder of what you added in 2024 and what you can disclose of plans for 2025.
Sure. So in Illinois, we did have processing facilities there that started in 23 and 24. We did build out and go live with our cultivation center. Like I mentioned before, we just had our first harvest. So we anticipate to leverage that asset and to continue to add flower in the state. Our edibles, Betty's Eddies specifically, has been a really good performer in the time that we've been there. In Missouri is a new market for us in 24. We added a processing capabilities and started to distribute some of our products at the end of the year. So we're seeing good ramp up there. Maryland, you're right. We did expand our cultivation facilities and double them. And we opened a second dispensary there as well. In Massachusetts, we added adult use to one of our medical dispensaries, and we added a second cultivation location specifically in Quincy. And Ohio, we added adult use as well to our medical dispensary. With respect to 25, our focus is to continue to leverage on those assets. We do operate in Delaware under an MSA. So we're looking to, at some point, when it's possible, to convert that to a consolidated operator in that state. And we just continue to look for opportunities, obviously, from an M&A perspective as well as organically. We obviously are always looking at how to better deploy our capital. But as of right now, no definitive plans to expand into any other new markets.
And just to be clear, in terms of the MSAs that you have in Delaware and Missouri, what is the holdup to convert to consolidating those businesses, especially in Missouri?
In Delaware, we're just waiting for conversion or approval of conversion to adult use and not for profit. So, I think they need to put someone into the commission, and before that'll happen, we keep waiting for the date, and it keeps being pushed back. So that's the only thing we're waiting for there.
Missouri?
And Missouri, we began to manufacture there and also distribute. We are looking at how we want to continue to expand in that cultivation in that state. But right now, we're just looking at various options and nothing definitive there.
Okay, but Missouri is an MSA right now, right?
Correct. Yeah.
Thank you. Roman, same question for you, please. If you can just remind us of where you expanded capacity, if in any place in 24, and plans for 25.
Yeah, I think in 24, mostly kind of a retail story. I think we added about 7 stores to our top line over the course of the year, with the 2 of them being acquisitions, the other just build outs under our existing licenses. And I guess the biggest catalyst, kind of a call out for us, was Ohio non-medical flip, right? Halfway through the year, right? So a few stores that we had converted to adult use overnight, second half of the year. So I think, as we indicated publicly, right, we see the benefit of that. And then we do have more stores opening in Ohio going into 2025 under the 10B program. And then, I also believe on the last earnings call, we indicated kind of a continuation of our densification strategy, right? So targeting, I think, all in 20 stores across the core markets, whether it's just the build out of, licenses that we have today, M&A, and then also, continue to build depth in these kind of partnership, financial support, service agreements type structures, right? So Illinois, New Jersey, mainly being the 2.
If you can, try to expand on that topic, especially Illinois and New Jersey, in terms of how do those partnerships work? I mean, do you take an equity stake on the company, or is it, support in exchange for having more of your product on the shelf? Do you take full control of the retail store? How does that work? Or it's a case by case pretty much?
Yeah, look, we pay a lot of expensive lawyers to tell us what we can and cannot do. But in every state is different, right? New Jersey, does have this structure available where you could come in as a minority owner, provide capital, provide back office support, amongst other things, right? Which help, social equity license holders to stand up facility, right? One of the challenges, and I think what all of these new, social equity licensees face is lack of capital, right? You can't go to the bank and just borrow basic working capital. So, unfortunately, under that structure, they don't have a lot of choices or options, right? These stores are expensive to build. These stores are expensive to stand up and watch till the scale. And frankly, the back end, right, whether it's, payroll compliance, all of this kind of infrastructure you have to build is also expensive, right? If you only own a store or two, to have, to have a legal service, HR, finance, accounting, right? All of these parts that you need to run a business, it becomes very difficult. So what we do is, we provide that platform, right? And we provide financial support. So we do lend and provide kind of working capital. And in some cases, like New Jersey, the state clearly allows you a 35, I believe you can have a 35% ownership stake. So again, every agreement's a little bit different, and sometimes there's path to ownership. So an option agreement to buy, it's up in the future when the state permits. In other states, again, it's more of like an MSA, more traditional MSA relationship, where again, we take risk, right? We provide sometimes the entirety of financial support and capital, and I'm sure folks agree here, right? Under accounting guidance, like you are kind of forced, in a way, you're kind of forced into consolidation, right? We take a lot of the risks, we do benefit, we do have economic benefit here as well, but we do take a lot of times almost, all the capital comes from us. So anyways, that kind of triggers consolidation. And we do see that, and I think our partners, I see that as a win-win and a mutually beneficial relationship, because again, they don't have to worry about building all that infrastructure. We have the scale, we have the rates. We can add 20 stores to our network, to our portfolio, and not really deal with that much more incremental indirect costs, right? So really adding a store that we can supply product to, that you got to put employees and obviously pay rent and other small SG&A items. But on the corporate side, as far as leverage goes, it doesn't require us to add a lot of bodies to support 10, 20, however many stores, right? So that's really an opportunity for us going into 25. And then also when we do that in places like Jersey and Illinois, where we have so much capacity to make and grow, right, it becomes extremely accretive to our overall business.
Would you say that in that sense, New Jersey is more flexible than Illinois in terms of your ability to partner with these new stores?
They're different, right? Illinois has caps, 10 caps. In Jersey, I think and there's been some recent rule changes, so I don't want to misstate the regulatory framework, right? But New Jersey does, I think, allow you in some cases have direct ownership up front. Is one better than the other? I think it's hard to say, right? Because again, there's a cap on how many you can do in New Jersey, and Illinois has different set of caps. So, and then you also have to put it in the context of how many other operators are there, what kind of your own capabilities you have in the state. So when you kind of put it all together, like what is it, what's best for us may not be what's best for somebody else.
Understood. Look, and Mario, I'm going to move on here in terms of the topic of retail, right? But trying to understand, we've already talked about the store proliferation in some states, the revenue per store erosion, although it creates opportunities on wholesale and also for partnerships. But in terms of the latest regulations, and correct me if I'm wrong, Maryland has a cap on stores, and I don't think new stores can open yet, so that market is somewhat protected. Correct me if I'm wrong. Illinois was 110 plus 185 social equity. They're already, I think, in total at 241, so there's still some more left to open. But any Massachusetts, you have a cap of 3 and they keep opening stores. Any quick comments you can make based on what you know, Mario, about how do these your core markets evolve from a retail perspective based on what we know about regulations?
Yeah, so obviously our strategy is just to focus in those markets that have limited licenses, and so we're at 5 in Illinois, and the cap is 10 there. In Massachusetts, we're at a max there, right? So we're focused more on just continuing to drive our brands on our own stores and across our distribution channels from a wholesale perspective, and just like focusing on our customer, right? Looking at our loyalty programs, providing a lot better customer service, making sure our bud tenders are well trained so that customers enjoy coming into our stores and are asking for our products, right? That has been our strategy, and that's what we'll continue to focus on kind of going forward.
Thank you. Look, the last question on retail, Roman. In terms of the 10B program in Ohio, I keep hearing different things. When is that starting? I mean, do you know when you can start adding more stores, or that's still unclear?
Yeah, I believe that all happened last year, if I'm not mistaken, right? So I think, and again, I'm somewhat removed from the regulatory work that we have folks involved in, but I believe, right, if you held certain licenses, and again, that may have been just applicable to our type of license, right? So you were awarded an extra retail license. So that's kind of what we refer internally as 10B. So again, from our perspective, right, it was basically a set of licenses that was received because there was an existing license at a point when the state went adult use.
Understood. Thank you. Look, I'm going to move on now to the state of the balance sheet of the companies. I'll start with you, Dennis. If you can remind us of your debt leverage. I think you have a net cash position in your case. How you describe the current landscape to access debt capital, any potential implications on the recent negotiations within IPR and PharmaCann on the sale leaseback. Any comments in that regard, Dennis? Thank you.
Yeah, so I'll start high level, and talking about the end of Q3, sort of 26 million in cash. We have a $5 million seller note due April 1st and 3 million in a loan with a regional bank in Florida due next week. So we're in a good position to pay off both of those this year and not really have any issues. We don't have any other third-party outside debt. Outside of the small loans, one loan I think that's 10 years old that we're trying to take care of in Nevada. So not really exposed to debt. We've always been sort of adverse to adding debt capital. Fundamentally, the view of the executive has always been, it's not tax deductible under 280E. It's been anywhere from 9% to 18% all in cost of debt, and it's been extremely expensive. And now we're in a situation where we see a number of players in the industry having to renegotiate, refinance a lot of debt coming due in the next kind of 2 years, and so we're not in that position. So I think we're benefiting from that a little bit in the short term. The PharmaCann situation hasn't really impacted us too much. I mean, we do have all of our stores in Florida are leased. Our Nevada stores are leased. Illinois we own, and California is leased. Most of them are at market rates, so that we haven't really had any issues with our landlord there. In accessing debt capital, we keep getting inbounds from providers of debt capital. I think everybody knows who the main participants in that market are, but we just don't like the terms, and so you're just not open to debt in any significant way outside of mortgage debt on buildings, et cetera, that we can treat more of it like a long-term payment plan. So that's sort of where we sit on the debt front.
Thanks, Dennis. Mario, the same question for you. Just start with the debt leverage, state of the balance sheet, maturities coming up. Thanks.
Yeah, our strategy has always been to grow in a sustainable and kind of measured way. We have about 60 million debt on the balance sheet. It's all mortgages. We don't have any leases and don't plan to enter into any leases. We've, you know, we, from a balance sheet perspective, our cash was at the end of Q3, 10 million. My focus is always obviously on cash and preserving cash. There's a lot of catalysts out there that everyone's kind of waiting on to really unlock some value. So the key is those companies that are able to preserve that cash and kind of ride it out the current regulatory environment.
Thank you. Roman, the same question for you, and also read across some IIPR from Magan if you have. Thanks.
Sure. I mean, look, I think we feel pretty good about our balance sheets, right? Our 20 We took care of that refinancing back in the summer of 24. There's a small stub that's left that we expect to kind of take care of before it comes due. We have a backstop, and we're not concerned about that piece. But otherwise, I think we like where we are on the cash side of things. And from just a holistic perspective, right? We've maintained very good relationship with our lenders. Our largest lenders they're still with us, and in a way, it's enabled us to go from $12 million in revenue not that long ago to over $500 million, and we can continue to scale business from here without having to raise those kinds of funds going forward. So, our focus is on, again, as we indicated in Q3, right, look at the cost side of things on the business, which there were a lot of low-hanging fruits. So get back to kind of, making sure we utilize working capital best way possible. And then as we add more stores, right, we believe that to be a very accretive exercise for the org. And obviously, free cash flow is being a very important metric that we manage ourselves to as well as our board.
Any read across on the PharmaCann IPR matter? I mean, I think the PharmaCann rates were quite high, so maybe that was very unique, confined to that case, or is there room, do you think, in the market for rates to come down, for the leaseback guys to bring the rates down, or that's wishful?
Yeah, I mean, not a lot of updates on our end, right? We obviously noticed the announcement, and it's gotten a lot of attention in the industry. We are one of the IIPs. We are one of their biggest tenants. So of course, we want to look at it, but at the same time, these are, majority of these leases are at our cultivation sites that are operating well and at good scale. So, again, like no updates on our end thus far, but certainly something we're keeping an eye on.
Okay, thank you. Look, the last question on the balance sheet and cash flow is regarding the topic of 280E. I'll start with you, Dennis. I mean, for those that are new to the industry or not so familiar, a lot of companies to deal with the challenges of 280E have decided to start provisioning for taxes as a normal corporation and allocate the balance to long-term tax liabilities, right? And it's a way to challenge the regulatory system, right? And I think Trulieve started with that, and most companies started to follow. And in my opinion, why not, right? But I want, if you can remind each one of you, what's your stance on 280E? Are you expecting to get any big refunds back from 2022? Is it true that some started providing as a normal corporation for 23, 24? Dennis, I'll start with you.
Sure, Pablo. So we were current in our tax payments under 280E until September of 2023. And so we'd paid, 19, 20, 21, 22. We have taken the same position that Trulieve has taken, and we've applied, we've filed amended returns for 2020, 21, 22, and are in the process of filing 23 amended to reclaim the interim tax payments we made in the first 3 quarters. So total exposure for us is about 36 million, between 37 million in back taxes that we've filed to amended returns on. Whether we get it, who knows? The position we have taken go forward from that date is, we're still taking a full 280E provision. Want to avoid an uncertain tax position on the balance sheet, especially with respect to the auditors, but we are paying estimated tax payments as if we're a normal company. So you are seeing our, income tax payable balance on the balance sheet continue to grow kind of quarter over quarter. You saw that through the 24, where we have not made payments under 280E, and will continue to do so. There are, a couple of cases that are ahead of us that, we think that will get resolved. We'll have some more clarity on that position with the IRS, sometime over the next 12 to 18 months, but, not counting the benefit of that 36 million until we actually get a check. And then even then we will hang on to it and wait and see what the IRS wants to do in terms of challenging it.
And when you talked about the two cases that are outstanding, you're talking about the Boyas lawsuit or something else?
I'll get the exact ones for you. I can't remember the names off the top. I think Canada Provisions, maybe. I can't remember which ones are ahead of us, but yeah.
Roman, same question on 280E.
Yeah, I mean, it seems like the industry has kind of taken a stance, or at least vast majority. I'm not privy to what Trulieve took and what kind of opinion they're relying on, but from our perspective, the opinions and the paperwork that we have kind of supports a reasonable basis position. And again, much like everybody else, filed amendments very early in 24. We've received some refunds that we've also disclosed from the states. In terms of IRS and 280 tax, right? Similarly, we pay 280E from inception through about 2021, going into 22, and post these amendments, right? Our position is that as a regular taxpayer, we have a net receivable from IRS, and for the moment we're not paying 280E, and we're also again challenging that on the basis that there's a net refund, that those payments could be applied against current non-280E taxes. Again, that's more of an IRS federal position, right? From the states. All of our states have decoupled, so we pay. We don't pay 280 tax, right? We make those estimates quarterly, so we stay. That one's pretty kind of clean cut. Similarly, I think expectations this eventually gets resolved in courts, right? Boy Schiller is the lawsuit out there that I think everyone's kind of looking at, but I'm sure there'll be others. So I think that's kind of my take on it, is this eventually goes through courts. Again, we believe we have reasonable basis. It's, reasonable basis is not strong enough to not show 280 tax exposure on the balance sheet. So I think us, like everybody else, is carrying that out there. But from like statutory perspective, we'll feel good about what we filed, amended, and so do our tax preparers, auditors as well.
Thank you. Mario, the same thing on 280E, please.
Yeah, we're in the same position. Nothing kind of incremental to add. We've just been recording our provision and liabilities on our books based on the current legislation. We have filed amended returns for 2020 just to preserve our statute of limitations with respect to that year, and we'll do so going forward. But at this point, it's just a wait and see attitude. We're all in the same boat as it comes to figuring out what's going to happen from a reclassification 280 changes.
Thank you. So look, I'll move on. I'll move on now the discussion to the federal reform outlook. But the way I want to ask the question is, how do you plan around the various reform scenarios, right? We all may have expectations of what may or may not happen, right? But you're still running a business, and you still plan, hope for the best, plan for the worst, right? So in that sense, what would you say to investors that are so focused on the news flow about reform at the federal level, and they maybe miss out some of the things that are happening at the company level? But again, I mean, that's a long-winded question. But first, your views on what may or may not happen at the federal level with reform. How do you plan around that? And if you have anything new in terms of key states in your footprint that may have positive news in terms of becoming rec. Thank you. I'll start with you, Dennis.
Yeah, I mean, Pablo, I think investors have been disappointed over and over and over again in the last, since I've been involved in the business since 2018. And so we don't plan for any federal reform to actually go forward. And we're running the business in the current market environment. And if reform happens, it'll be fantastic. We're seeing some opening on the banking side now, more so than sort of 2, 3 years ago, where we have some regional banks willing to provide cannabis services to us. So we're kind of, historically, it's been the credit unions that have stepped in and filled that void. Reform would be fantastic, but we need 280E and we need safe banking, because without safe banking, yes, we get the tax relief, but we don't get the benefit of taking credit cards and doing normal payments and participating in the financial services framework to really drive revenue. We had a credit card solution for a number of years, I think 18, 19, part of 20, and the average ticket was 25-30% higher than when we didn't have it. So it has a big impact on retail operations for sure. But we're not planning for any real movement in the federal level at this point.
You said that on the lending side, regional banks are more willing.
No, they're just providing banking services,
Banking services.
So we do a little bit on the lending side. So we do have a line with one regional bank that we didn't have before that we can access, and actual banking services. Whereas the credit unions have a kind of a cannabis program. They have to vet the suppliers and make sure that the non-plant touching, plant touching separation. The regional banks were not really willing to go into that market, and now we're seeing them kind of step in and we're getting more normal banking services, corporate credit cards, that kind of thing, but not any benefit on the retail side of the equation in terms of being able to take credit card payments at the till. So.
Mario, same question. Your views on what may or may not happen at the federal level, and how do you plan around it? How do you run your business?
Yeah, I'm relatively new to the industry, and I'm kind of, frustrated that none of these catalysts are happening. So I can imagine people who've been in the industry or been invested in the industry for a while. We're cautiously optimistic as well that things will change. The standard response is it's just a matter of time. So, we're focused on what we can't control, right? So we're positioning MariMed to thrive under the current environment. And, mixed messages have been coming out of DC, but as the new administration kind of forms itself, we have it looks like we have some pros, we have some cons. It's a matter of when, but can't plan for that. So we're just focused on what we know right now and making sure we're set us up for long-term growth. And as some of these regulatory catalysts start to open up, we think we'll be ready for those as well.
Thank you. Roman, the same question for you.
Yeah, I mean, look, having been in the industry since 2017, right? I think folks have kind of learned their lesson. I'm not aware of anyone who kind of plans their or have as an operating plan that incorporates federal legalization and all the things that come with it. So I think for the moment, you just kind of you work with what you have, and whether it's access to, right, capital markets or just basic infrastructure, right? Think about, mentioned treasury is one, but anything from point of sale, how you run payroll, like everything you're doing with just not great options, probably not even second or third tier options. And that's unfortunate, but I think most, like including ourselves, have kind of accepted reality, and you proceed according to that plan. If something changes, that's gravy, right? We'll take it.
Well, that's great. Thank you. Look, I know we're getting here close to 50 minutes. We'll move on to closing remarks. I'll start with you, Roman. In particular, if you want, pitch your stock to investors. And if you like, tell them what they should focus on, given the regulatory uncertainty at the federal level, what they should focus on when choosing MSO stocks. Go ahead, Roman.
Yeah, I mean, look, I mean, I know we've done a lot of that in Q3 earnings, and we have a whole new management team in place, new old management team, right? So, folks that helped create the company, that contributed to the growth that we saw from again, where the company was in 2019, 2020 to where it was in 2024. Um, and we gotta need some time, right? But from our perspective, the initiatives that we outlined in terms of making the company operate more efficiently, focusing on the customer base, focusing on assets, resuming the growth that we've seen from the past, adding 20 stores and densifying in markets where we have some of the highest return on capital and is going to be, extremely accretive. We see a lot of opportunity in that. And so, I think for us, it's kind of getting back to basics. And now we got to execute, obviously, but if I looked at the map and I look at our portfolio and the markets we're in, I mean, these are the best markets from our perspective that anyone would want to be in, right? As far as limited license, but still good valuation on product, good margins. Yeah, I think, we've always believed, we've been undervalued relative to our peers. And, now we just kind of have to show, why that may not be right.
Yeah. And just to be clear, when you say, I mean, for the audience, when you say densifying, you're referring to, in the case of New Jersey and Illinois, ways to go above the cap by entering these partnerships, right? Which are two states that
Yeah.
it's a
We
great.
never chased, that's right. So we never chased flags just for the sake of having flag in states, right? That was never our thesis from even beginning of times, right? It was, I think the kind of Cannabis 1.0 was all about how many states you're in, right? And that's what you saw, map lit up in flags. And that was very capital, that was very expensive in many ways, not very profitable, right? Our thesis from the get-go was depth, go deep, be the best in the market you're in. And, I think the core markets we are one, our brands are obviously performing well and, we have the stores and the retail to show for. So it's really just, yeah, going deeper to the extent it's allowed under the regulatory framework. And, we're obviously always on the lookout for, if a new market makes sense, we won't shy away from it, right? But it's that focus. And again, it's the leverage that our business has to add an extra 20, 30, 40 stores without, again, changing our SG&A and the direct cost basis or the corporates or overhead drastically, right? That is, that's very exciting. So that's what we look forward to in 25. And, we just kind of have to show how that we can execute.
Great. Thank you. Mario, closing remarks. And again,
Yeah,
welcome to the Cannabis space. You're a new CFO here. We'll hear you on the next earnings call, which you just joined recently, right? I believe. Well, yeah. But anyway, thanks for joining us today, Mario. Yeah.
yeah, no, thank you. Thank you for giving me this opportunity to meet some of my peers and kind of talk a little bit about the industry. It's definitely a complex industry and it's definitely evolving. And I really believe sustainable growth will separate the winners from the rest of the pack. Our primary focus is on our brands. We want to be, our North Star is be the number one edible in each of the states that we operate. So we focus on quality. We focus on innovation. When it comes to production, we're always looking at ways to be more efficient through automation and just reduce our costs there. We have a really strong balance sheet. John, our CEO at the last earnings call, talked a lot about the value of our brands, and they're not reflected in the share price. We believe we're a really a value stock, and so from a for my perspective, my focus is on just preserving cash and deploying capital where we can continue to execute on growth and make it sustainable. We want to leverage the assets that we expanded on in 24. And when it comes to new markets, just really be thoughtful in terms of, continue our strategy in terms of limited licenses and make sure we're not adding any debt to our balance sheet. That's not necessary.
Thank you, Mario. Dennis, closing remarks.
Yeah, so just Planet 13 really focused on our two core markets of Nevada and Florida. We see a lot of upside potential in that Florida market, executing on our 2024 acquisition of VidaCann and growing that, the average revenue per store, getting it back closer to the state's average. We think there's a lot of upside in Florida for us, notwithstanding the Delta 8 discussion we had earlier on. If we can get that under control. And really focused on, what Roman and Mario have both indicated, driving cash flow and margin and leverage and making sure that we can be profitable in our core markets while, maintaining an experiential retail experience for our customer base. So.
Thank you, Dennis. So thank you to all our speakers for joining us today. And thank you to the audience that dial in Spaces and via Zoom. Everyone have a good day. And again, my only message is that there are, very good operators in this industry. There are challenges on the regulatory front, but, do your homework as an investor and see how companies are performing. And obviously it's a real industry, to state the obvious. And the focus should be beyond just reforming news flow, but also on how companies are building their businesses and performing. So everyone have a good day, and thanks very much again.
Thank you, Pablo.
Thanks
again. Thanks, Pablo.